Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. It seems that at least one video a year is focused on precious metals. The reason is that one or the other of certain factors often takes center stage, such as inflation, currency debasement, sovereign debt monetization, competitive currency wars, de-dollarization, or the status of U.S. dollar reserves. In this session, however, we have another reason to talk gold, and that is the fact that it is once again assuming its long-held role as a geopolitical risk hedge. In my mind, it has been a couple decades since this was actually the case. Specifically, the last time I saw gold spike, like it has in recent weeks, was on the morning of 9/11. I remember it well because before we even understood what was going on, we knew something serious was up because gold was reacting as it normally did as a hedge against some sort of major geopolitical shock, not yet fully understood. I want to show why I believe this is now again the core reason gold has recently spiked and why this renewal of its past status as a geopolitical risk hedge is going to be very important in 2022. As such, I like to discuss the topics outlined here. First, with the positioning of what is happening, is a reminder of our 6 major macro themes for 2022 and the supporting 9 investment themes we outlined in the year beginning under the lens and LONGWave videos. This slide summarizes both with the 9 investment themes highlighted in red. The first is the weakening U.S. leadership role on the global stage, and how, as a result of this, 2022 will be punctuated with major geopolitical events. We produced this list and the 2000 macro thesis video long before there were winds of war in the Ukraine. We highlighted it because it was part of the world shifting from a unipolar world to a multipolar world. We'll talk more about this later. We actually started writing extensively about this coming shift in our 2018 thesis paper, A New World Order. We felt the U.S. debacle that was the Afghanistan withdrawal sent a clear message to the world. It wasn't that the U.S. was withdrawing. It was the shocking way it was done. A superpower does not conduct itself in such a fashion. Only a broken power does. It laid bare to the world the very serious problems that the U.S. as the torchbearer for the free world had. The incompetence, lack of foresight, leaving people behind, deserting its supporters in the dead of night was something even American citizens had problems believing was happening. To foreigners, however, it matched the news coming out of the U.S. of broken borders, law and order breaking down, smash and grab, thieving happening without prosecution, and what appears on this nightly news broadcast around the world of a complete political disarray in the U.S. Congress. Americans don't fully appreciate the detail of how what is going on in America is seen by the citizens of the world, including despot rulers. It was a sure bet that the enemies of the U.S. were not going to let such a situation go by without fully capitalizing on it to their full advantage. We see the Ukraine conflict as only the beginning of what is yet to come. China, Iran, North Korea, and many other disenfranchised sovereign states will soon be much more aggressive. To Americans, it's likely to be something we've never experienced nor believed could happen. This is seen in the U.S. leadership polls of the current administration. They are at near historic lows for any U.S. administration. The geopolitical turmoil and financial fallout presently occurring globally is dramatic when you stop listening to the mainstream media and actually delve into the underlying financial details. Let me take you on a tour so that you gain some perspective on what we have seen and are now witnessing. A whopping $46.3 billion has fled to cash, the largest inflow in 9 weeks. $1.9 billion has fled to gold. Meanwhile, approximately $5 billion has been pulled from equities in the first outflow in 10 weeks and $10.6 billion from bonds. We have just witnessed the largest outflows in European equities ever, at $6.7 billion in a single week as investors dumped the one trade that everyone in Wall Street was consensus bullish on just less than 1 month ago. We just had the largest outflows from global financials on a weekly basis ever at $3.5 billion. We had the largest outflows from mortgage-backed securities since March of 2020 at 1.6 billion, front-running end of QE. The largest outflow from real estate since May of 2020 at 1.1 billion. The largest inflow to energy since March of 2021 at 2.4 billion. The largest inflows ever to materials at 4.1 billion. The Russian ruble has completely collapsed, which is not only a problem for Russia, but European banks who have heavily financed Russian energy expansion, in many cases in Russian rubles. Russian bonds have become almost worthless collateral. This hurts value at risk requirements for banks around the world holding Russian assets or tied to them in any way. Russia is now basically giving away its oil to find buyers. It is selling at a $28.50 discount to Brent the last time I looked. Russian stock values have simply disappeared, and the list goes on. With European banks in trouble, and particularly the major banks in France and Italy, exploding EU energy costs and shortages went from a major concern to crisis levels. Meanwhile, the average price at the pump has exploded higher, with the second biggest jump ever, looking set to go even higher given the price of crude and wholesale gasoline. We've been a major proponent of the commodity supercycle, which has been a big beneficiary of the political and financial turmoil we're seeing here. We believe the market is finally starting to sniff out the coming stagflation, which we have also been writing about. The net result of all this has been a flight to safety. The traditional flight to safety has been to the US dollar, often in the form of US Treasuries. The last spike up in our target price and time objective reflected this. On the other hand, we are not at all confident this will last. In fact, as reflected by the dotted red line on the right, we are decidedly in the camp of a weakening dollar in 2022, which we have outlined in previous videos specifically on the US dollar. Gold has also been the recipient of this flight to safety since last January, as can be seen by the shaded area. We have put in recent highs that show a double top formation against the 2020 high that kicked off a approximately 20-month consolidation before leaping from a coiled spring position. Our view, however, on gold is that it is only beginning to be a flight to safety instrument as it increasingly becomes once again a geopolitical risk hedge. We are now experiencing the results of mounting global tensions and the beginnings of a shift in the world order. We laid this out beginning in 2018 with our thesis paper, The New World Order. We followed it in 2019 with our annual thesis paper entitled De-Dollarization, and in 2020 with our thesis paper entitled Global Conflict. For new subscribers and Matasi followers, all three of these papers are archived for download at the matasi.com website. In Global Conflict, we specifically address concerns with Russia, China, Iran, and North Korea, all four of which, along with others, will be prominent in the news in 2022. What we need to understand is conflict or war is inflationary. Conflict or war is also stagflationary. And conflict or war creates recession, often deep and protracted ones. It will likely be the same again. Over the last decade, the world has gone through profound economic, financial, and social changes, all important, but when taken in mass, leads to secular regime change from globalization to what I call the three I's: inflationary isolationism, that is human, social, regional; intervention, that is sanctions, confiscations, tariffs; and insecurity, that is trust in a global financial system. This means a new era of inflationary boom-bust cycles seen in a secular reversal in inflation versus deflation assets, commodities versus bonds, and value versus growth, all of which we've been talking about for a couple of years now, in the ongoing shift from capitalism to creditism to what is on the verge of becoming broad-based socialism, as well as a shift from a unipolar world that is centered by the US to a multipolar world with increasingly strong regional superpowers. What we need to remember is that historically, the great game, as it is referred to in geopolitics, is always about energy: who has it and who needs it. Those who command it have control and advantage with economic production costs, productivity levels, and standards of living. The last time we saw a major problem with inflation, economic growth, and stagflation was in the 1970s. There we also found energy at the center of the problem. Energy independence has proven to be a cornerstone of sovereign liberty. Without it, tension, crisis, and conflict often arise against those powers who have it. With gold becoming once again a geopolitical risk hedge, we need to revisit what has been driving gold pricing over the last decade and a half. Also, what has been driving its valuation. First is inflation, as measured by inflation break-evens. Shown here is the benchmark 10-year break-even inflation rate from the Federal Reserve. As inflation break-evens rise, gold rises with them. When they fall, gold falls with it. This is why we haven't seen a surge in gold for a few years, as central banks desperately tried with monetary initiatives to drive inflation to their 2% stated goal. Inflation was too low and a problem for central banks as it steadily fell until the COVID pandemic and money printing stimulus exploded. This heralded in a short-term problem of just too much money chasing too few goods. We now have 10-year break-evens at highs not last seen since 2004 to 2006 and CPI prints at levels not seen since the 70s and in some cases never before. Secondly, gold moves inversely to the real rate. Here I show the 10-year Treasury inflation-protected securities, or what is called the TIPS. Gold tracks very closely to any drop in real rates. You can see it has been steadily deteriorating as it went negative in 2020 and is currently at approximately negative 1.0% as reported by the TIPS index. How these tie together is based on what is called Fisher's Law. The U.S. Treasury note yield equals the 10-year break-even plus the 10-year real rate, normally measured again from the 10-year TIPS. Therefore, from this chart and the last one, the 10-year U.S. note should have traded at 2.77% plus negative 0.99%, or a total of 1.78% on March 7th. In fact, that is what it did do, after falling significantly from over 2% 2 weeks before. The reason is the significant moves in both the 10-year inflation break-evens and the 10-year real rates as shown here. The reversal is unprecedented, but even this move didn't justify the move in gold to all-time highs on Tuesday, March 8th. And that is the point here. The difference with the net change in the inflation break-evens and the real rate is geopolitical risk being priced into gold from the fallout from the Ukraine conflict. This is about geopolitical sanctions and their unintended consequences. We saw that across the raft of charts we showed previously. I show here an illustration reflecting the gold reserve holdings and changes of central banks around the world since 2000. Most global central banks' holdings have been flat to slightly down, with some blatant exceptions. Those being Russia, it increased its gold reserves by 443%. China increased its by 393% on a particularly large amount. India increased its by 891%, and Turkey increased its holdings by 352%. What's going on here? These are major countries aligned in many ways against a U.S. unipolar world and the control the U.S. dollar has over them, as the U.S. exports its inflation from consuming more than it produces to others. This has been going on for a few decades now, but is quickly coming to an end. These are countries doing everything in their power, including alternatives to the SWIFT system, to stop the U.S. weaponization of the U.S. dollar as its foreign policy instrument. I laid all this out in our most recent newsletter entitled Ukraine Places Focus on a Failing U.S. Energy Policy. Don't for one moment allow the apparent size of the U.S. gold reserve holdings shown here fool you. For decades, the U.S. leased out its gold holdings. Many of those large bullion bank leasers sold that gold and it was turned into jewelry. How exactly are you expected to return the gold to the Federal Reserve? If the counterparty is incapable of returning it or buying it from others at a price it can afford, the leaser goes broke and the U.S. gold reserves disappear in bankruptcy court. I hope you can see how gold and inflation over the years was manipulated through this sleight of hand. A day of reckoning is coming on exactly what is the true value of the U.S. reserve assets. Is it any wonder these countries can't accumulate gold fast enough? Gold is their ultimate hedge against this exposure. it is also your geopolitical risk hedge that comes from this. So what are our conclusions? A recession and an era of stagflation is dead ahead for the U.S. and possibly for a big part of the global economy. It will be very problematic for the U.S. particularly. Secondly, many of the issues we've been writing about are now upon us, which will drive geopolitical risk and hence a geopolitical hedge like gold. Of the many changes we should expect resulting from a highly interconnected, socially networked world, all laid out in the 2018 New World Order thesis paper, was the shift we've been discussing here from a unipolar world to a multipolar world. This will mean strong country and regional powers, which inevitably will lead to major conflicts. In the 2019 thesis paper, De-Dollarization, we laid out how the continuous, ongoing use of sanctions effectively weaponized the U.S. dollar as a tool of foreign policy, which was fraught with problems. In fact, over the last decade, the broad range of impacted nations have adjusted for this, prepared countermeasures, and will be less tolerant to what they believe is a belligerent and corrupt U.S. foreign policy. In 2020 thesis paper Global Conflict, we laid out why broader global conflict is soon to control the social order. It won't be just military or cyber conflicts, but through other tools using the media, social networks, social influencers to control the narrative, attitudes, and demands of its citizenry. It's a much more subtle form of modern 21st century warfare. Expect it to be a brave, new, dangerous world. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems, until such time as no one will actually take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will be forced to react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has seldom actually been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2022 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.